I think it's critically important to one's long-term financial success to realize that trying to time entry and exit points into the market is just fraught with so much opportunistic risk, because the price of being wrong is very, very dear, particularly when savings rates are as low as they are, outside of the issues that you mentioned where that savings might need to be there for other issues. But just to trying to protect oneself from volatility in the stock market by going to cash, it just has not worked. The opportunistic costs of that for the last decade plus have been just huge. I think sorry, go ahead.
The financial crisis, of course, too. The people who got out of the market and may have timed that correctly, but the rally and the recovery came so fast and so furiously that most, even institutional investors, missed it. Right. So that's why and today we saw that if you went into cash, and then today against all greater intuition, we have the markets up 5%. So
exactly. I think the volatility, I think we all have to understand that volatility is an inherent part of any of capital market structure, to greater degrees sometime and lesser degrees in other times. And that, we've done a lot of work around this, and on a calendar year basis, at some point every year, going back to, I think it's 1980 that we started, every year since 1980, at some point during the calendar year, you get a negative return on the index, at the index level. There's a drawdown there. And in my opinion, it always comes back to how you respond to that particular event that determines your ultimate financial success. Because we know that there will be that drawdown. But the other piece of evidence that we also know, given long-term financial history, is that 70% of the time, on a calendar year basis, you get a positive rate of return on the stock market. So if I take those two things together and I say, okay, I know that sometime during the year I'm going to have a negative experience. It might be longer or shorter, but I have a 70% chance of ending the year with a positive rate of return. So as long as I don't react to the negative experience by trying to make some adjustments around timing entry and exit points, I have 7 out of 10 chances of ending up in a better place by basically just staying with the investment plan that I've put in place.